this piece, I want to talk about life insurance. It is a staple of our company's offering. We are mortgage specialists. We're also specialists within life insurance, critical illness, and the sort of what's called the protection arena. So I want to talk a little bit about the regular issues and pointers that we want to give to our existing clients when we're reviewing existing policies, because this just might resonate with you. So these are common things that we find. The first thing is, when we're reviewing existing life cover, is that we find that the term remaining on your life policy does not match that of your mortgage. It would have done when you originally took it out. Maybe you took out a 25-year mortgage, so you take out a 25-year life insurance policy. The two go in sync. When the mortgage is paid off, there's no need for the life insurance policy. Nice and easy. However, life gets in the way. You move house. You get a different mortgage. You get a different term, or you borrow more, and so you extend the term. And so the last thing that you want is to find out that these are a mismatch when you need to claim on your insurance and to find the insurance has actually ended, but your mortgage is still there. So dust that policy off now. Check how long's left on that life insurance policy. See if it matches your mortgage term. And if it doesn't, get in touch with us. Sadly, it's not as easy as just ringing your existing life insurance company and saying, will you extend my term? That's not something they do. You have to start again. And if you're starting again, it's best to start off now, not in 5 or 10 years' time when that comes to the surface, because you're 10 years older, and guess what? Life insurance policies are more expensive. So have a look at it now, dust it off, and check the terms that are remaining. The other thing that we notice on a really regular basis, because getting life insurance to repay your residential mortgage is the first rung on the ladder. So here's the point I want to make. You may have life insurance to pay your mortgage off, but what if the person that got squished under the bus was the major wage earner? And even though the mortgage is paid off, you've also lost the main income coming into the house, which is substantially more than the mortgage payment. So from a cash flow point of view, you're actually worse off. I'll say that again, from a cash flow perspective, even though the life insurance has paid the mortgage off and saved you £500, £600, £700, £800 a month, whatever it is, you've lost the income of your spouse or partner. How much was that? 30 grand a year, 40 grand a year. So you're actually worse off. And it could easily be that you cannot afford to still stay there. So you still have to sell the marital home or the family home, that home that your kids live in, which was the whole reason you got the initial policy. So what am I saying? You may need two policies, one to pay off the mortgage and another one that pays a lump sum into the family coffers so that the person remaining can stay in the house, pay the bills, keep the roof over their head. It's so often people don't think of that second policy or do the maths to see, well, what would happen to us? Are we at risk? If the answer is no, okay, you don't need it. Do the maths and then take a view. You can tell I'm passionate on this. And the last thing that we do come across from time to time, clearly there has been a trend for a lot of years now for people to quit smoking. But we also see that when the original life policy was taken out 10, 15 years ago, you were smokers. Typically, this, I'm really generalizing here, if you were taking out a life policy today, one quote as a non-smoker, the next quote as a smoker, the smoker policy will be 50% more in premium than the non-smoker. That's how much they weight the premium when you become a smoker. The reverse is true when you become a non-smoker. So the proof has to be that you've quit smoking for 12 months. And I do mean quit, not patches, but you've got to quit. Now, some of you might be thinking, well, what if I just said I quit 12 months ago? You can, it's up to you what you put on the application form, but the insurer may ask you to take a test, some sort of screening test that does some assessment as to whether there might be any residual nicotine in your body. But once you've quit for 12 months, then the insurer class you as a non-smoker. So it therefore is appropriate that you review your existing policy. And again, we can advise you about what are the best rates and saving your money. My word, not spending more money on insurance, but actually saving your money and having the same cover that you had before and putting something back in your pocket. So some things to think about there. If any of that resonated with you, again, there'll be a link at the end of this piece to our online diary. Speak to our insurance advisors. There's no charge for that. Have a chat. See if we can either save you money or, more importantly, get the appropriate fit for purpose policy in place. And then you can forget about it for, who knows, till that next review a few years down the line.